My name is Katie Gillan. I am the Director of Education and Community Engagement for BBB Serving the Heart of Texas. Ooh, what happened here? Hold on just one second. There we go. For BBB Serving the Heart of Texas. So I am located in Corpus Christi. I service the Coastal Bend area, but we are under the umbrella of Serving the Heart of Texas, which encompasses 105 counties within the state of Texas. So we've got Austin, Waco, Bryan, College Station, Permian Basin, San Antonio, Laredo, and me, Coastal Bend. So I'm sure we're going to have people from all across our service area. So if you guys are just now coming into the room, you are muted and your cameras are off. But any questions that y'all have, please feel free to put them in the chat and we will get to those probably at the end. We're going to leave some time at the end for some discussion and to get to those questions. I do just want to remind y'all, if you've not been on one of these webinars before, BBB, we host these every single month. We try to always do the last Thursday of the month. I just have a big summit next Thursday, so I couldn't host next week. But we try to do these every single month, last Thursday of the month, always at 1 p.m., always at no charge to you. This is just a value that we want to provide to the small businesses in our service areas. So today we're going to be talking to Shalini Caldwell, CPA. But before I get to all of her stuff, I want to just give a quick mention because it's not listed on our website yet, but our webinar for October is going to be with Terry Moten, who is an AI officer, a chief AI officer. We've had Terry on for other webinars before. She's really, really great, very knowledgeable, a great business resource all across the state of Texas. And so in October, she's going to be going over AI and kind of some specific things that we can use it for in regard to our business. So even if you're already kind of proficient or already using AI, never fails. There's always some really tangible nuggets that you can take away. So that should be up on our website probably next week, but we'll get those emails will probably come to you. So now to get to today's presentation, again, we are having Shalini Caldwell, CPA. So Shalini was with us on our July webinar, same, business tax information, but it was just, we had so much information, so many questions that we really couldn't get to every single thing. So this is why we're having kind of a part two, but you didn't need to be here in July, to be here today. So Shalini has over 15 years of experience really helping entrepreneurs in their kind of tax journey and how to navigate that area that can sometimes be a little complex. So today we're going to go over filing your taxes, how to track and avoid compliance issues, differences between business structures and how that affects your tax burden and some other things that we'll go over. So again, please put in the chat if you have any questions or comments. And with that, I'm going to hand it. Oh, and it is being recorded. So this is going to be emailed to you once, probably in the next day or two. So with that, I'm going to hand it over.
Thank you so much, Katie. Good afternoon, everyone. Thank you so much for taking time out to attend this informational webinar. I have a small disclaimer. So this webinar is only for educational purposes, does not constitute any legal or tax advice. And I remember the July webinar was more focused on the entity structure and the different types of entities, and also like on the bookkeeping tips and how you can save in taxes, right? This webinar is focused on the OBBBA bill, the one big beautiful bill that got signed into law on July 4th, 2025. And there is a lot of buzz about the bill because people, I come with clients, I meet clients that come up with ChatGPT version of strategies and bill or they'll show me a TikTok video and they say, oh, is this true? We can take this deduction. We are eligible for this. I'm like, no, that's not true, because there's a lot goes, when we plan taxes, right? You really need to see your income threshold. So I'm going to focus more on the income threshold. And at the end, I'll show you what the planning, does when you meet a professional who's a certified tax planner, and how they meet you 4 times a year, not just once a year, to plan taxes, right? And also proactively and strategically, advising you on taxes. Give me 1 second. I'll just do the slideshow for this. Give me 1 second. Okay. So a little bit about me. I'm Shalini Caldwell, CPA. I'm a founder of my firm. I have a team of 5 accountants, including another CPA and enroll agent. I'm a certified tax planner, and I'm proud to say that I'm a recent winner of BBB Spark Award 2025 as well. So I'm going to jump on the OBBA and how it affects the individual taxpayers. Katie, are you able to see the slide
Yes.
extension of reduced tax rates?
Yes.
Okay, great. Because I did the webinar yesterday and they were not able to see the slides, and I'm like, I just want to make sure you're able to. Okay, so the first thing that the bill talks about is the extension of the reduced tax rate. Now, if you know, there was a change in the TCJA. The TCJA is the Tax Cut Job Act that is going to expire in December of 2025. The bill got signed, and people were worried that they will fall into the highest tax bracket that was 39.6 before 2017, right? But the Trump administration and the Congress signed the bill, and it came into effect on July 4, 2025. And the good news is that the reduced tax rate became permanent. So there will be no further expansion of the rates, or marginal tax rates still stay the same. Highest is 37% and the lowest is 10%. There is an increased standard deduction, which will be adjusted as per the inflation rate every year. So for this year, 2025 tax year, married filing joint will enjoy the deduction of 31,500, and single filers enjoyed 15,750. The next good thing for seniors over the age of 65 is that they can enjoy additional deduction of $6,000 as single and $12,000 as married filing joint. What will this do? This will reduce the taxable income, and so it will impact the tax due as well. But it does fully phase out at 175, Maggie, which is your modified adjusted gross income for single and 250 for joint, right? So these thresholds really, is an important key factor when you are talking about the bill with your tax professionals. They should know about this and they should guide you accordingly on the bill. The third thing is the dependent tax benefits. Child tax credit got a bump of $200. So currently the child tax credit is $2,200, right? But the phase out starts to begin at $200K for single head of household and qualifying widow, and $400K for married filing joint. And the child dependent tax credit, the percentage for the prior bill was 35, and now it's increased to 50%. But there is a calculation on the AGI. The credit percentage reduces 1% for each $2,000 for single and $4,000 for married filing joint if their AGI is over 15,000. Dependent care assistance contribution is for those who are working for an employer, and employer provides dependent care assistance program. The contribution increased from $5,000 to $7,500 for 2026. It's not impacting this year, but it's going to impact next year. And I also wanted to say that when I took the class with AICPA, that's our board, and the Texas CPA as well, the entire presentation was about 200 pages. So I cut it down to 27 because I wanted to bring the most important things that individuals and business owners should know, right? I mean, if I go over the 200 slides, that will take me the whole day. And I wanted to make sure that I capture the most important pieces that my clients need to know and the audience need to know, because we all are small, medium business owners and have individual, dependent, seniors. So I want to make sure that I cover the most important credits and deductions. The next thing is the adoption credits. Beginning tax year 2025, up to $5,000 is refundable. And again, this phase out when your modified adjusted gross income exceed 259K, and it completely phase out over 299, right? But you can carry it forward to the next year if the credit goes above 5,000. This is new and it's amazing because I have few restaurant employees. I have hairstylist as my clients where they receive cash tips and they work on overtime basis. So this is amazing for them, because when I did plan taxes for them, I'm like, wow, you can take up to $25,000 this year, and you will have a revised W-2 for this year, because your W-2 need to show how much is the cash tip that's allocated on your wage, and how much is the overtime compensation. And this will be applicable for tax year 2025 to tax year 2028 for another 4 years. But tips must be reported, and it does have a threshold. So the phase out limit for individual is 150. If your modified adjusted gross income exceeds 150, it completely phase out. And for individuals, it's for individuals, and 300K for merit filing jointly. And the deduction reduced by $100 for every 1,000 over threshold. Now, whenever you see your tax professional and talk about how much cash tips or overtime you're going to receive this year, they will do the math on their tax software and will let you know if you are under the phase out limit or you are over, right? So they're the ones who are going to help you with this. And taxpayer may deduct the amount of overtime compensation as well. Must be reported, and must be, the overtime must qualify Section 7 of the Fair Labor Standard Act. And deductions has two primary limitation. There is a dollar cap of $12,500 for singles and $25,000 for merit filing joint. And there is an income threshold as well, that if you exceed over 300K as merit filing joint, the deduction is reduced by $100. There are interesting provisions as well that I wanted, and this is my favorite slide. All of my clients are talking about, do I get this deduction for this year? Now, the first one is car loan interest, right? This is new. So this year, if you buy a car and you pay interest on the mortgage, on the car mortgage, the cap is $10,000 for this year on the loan. So it's a deductible car loan interest that can be deducted on your tax return. The next one is the mortgage interest deduction. Now, if you purchased your properties before 27, the cap was 1 million of acquisition debt, right? But after 2017, the cap is limited to 750. Now, what does that mean? 750 is the mortgage debt, right? So up to 750, if you fall under 750, you can fully deduct your mortgage interest, right? But if your total debt, let's say you have 3 properties, and your total debt is 1.5 million, right? So there will be a math, 750 divided by 1.5 multiplied by whatever the, multiplied by 100, right? That will give you a percentage, and that percentage will be allocated to your total mortgage interest, which will be deducted on your 1040. SALT deduction, which is our state and local tax, right? That's capped at 40,000. That's a huge savings. 40,000 for merit filing joint and 20,000 for merit filing separate. The phase out limit for taxpayer with modified adjusted gross income over 500K, but it will not fall below $10,000. So minimum, if your AGI is over 500K, the minimum deduction that you'll claim is 10,000. But if you fall, under 500K, you can take up to 40,000 of the deductions. There's another good news about the estate and gift tax exemptions, right? People were talking about, oh, it's going to cut in half. We don't qualify. We don't have a estate and will. I always tell my clients that a will and a trust is a really important document that you should have, because you don't want your beneficiaries to go through the probate process when you die. So it's very, very important that even if you have one house and you don't want your beneficiary to go through probate process, get a will and a trust for that. So for my high income earners, right, that have the net asset of more than $30 million, they qualify for this exemption, because the exemption is permanently increased to 15 million per person, right? So I have a client whose total net asset is 45 million, right? So up to 30 million, he will not be paying any tax. But for the remaining 15 million, he has to pay 40% if something happens to him or his spouse, because the total net asset is over 30 million. But there are strategies, there are gifting strategies, there are charitable, planning that we do for our clients who go over that threshold. 529 plans, if you have kids and you've enrolled your kids, if you have a 529 for your kids, the bill has expanded the type of educational expenses that you can qualify. So it's from K to 12. You can also get the college expenses deducted from 529, and the max cap is 20,000 per student. Casualty losses. Well, earlier it was federally declared disaster, but now IRS is going to recognize state declared disasters as well to qualify for casualty losses. Any taxes, any credits, like if you purchased any electric vehicle or any solar credits, right? It's going to phase out this year. So if you're still planning to buy a car, buy it before September 30th. And if it's an electric car, you will still be eligible for the credit. But credit does have a threshold too, right? You get that $7,500 as a credit, but if your total income is less than the income thresholds or not. Charitable contribution, this is starting from tax year 2026. Maximum deduction on your 1040 would be 1,000 for single, 2,000 for married. Usually charitable contribution, is a part of Schedule A itemized deduction, and you lose it, right? If your standard deduction is more than your itemized deduction. But for next year onwards, if you contribute $2,000 to a charitable merit filing joint, you contribute $2,000 to the charitable organization, you can claim it on your 1040 as a straight deduction. But the contribution exceeding 0.5%, which is the base, is deductible. And that's your adjusted gross income. Now I want to talk about how it affects the businesses, because I have a lot of business clients that buy equipment that are in, I serve close to 140 business clients, and most of my business clients are either small business owners in restaurants. They own restaurants, real estate, manufacturing, constructing. I have one client that has a roofing business, and it's the bill is same for every industry, right? How it's going to affect the businesses. But the key is how you're spreading the expense deduction on your tax return, on your business tax return, right? That's really important. So 100% bonus depreciation is back, but any asset that you place after January 19th will qualify for 100% bonus depreciation. Now, do you really need the equipment or furniture this year? If you don't need it, you can delay it to next year, right? Because bonus depreciation is still there at a flat 100%, right? So I ask my clients, if you really need it for your business, get it, but diversify the expense. You might not need that deduction this year. You can go with the standard depreciation, right? On furniture, you get that 5-year depreciation. You don't have to take bonus depreciation, right? But again, bonus depreciation is a really great component when you have a high taxable income or a high business income, and you're trying to reduce your taxable income so that your taxes can be mitigated, right? And please keep in mind that when you see your tax return and you go to the depreciation schedule, most of the professionals don't talk about that depreciation schedule itself. There is a purpose why we put a schedule on your tax return. When you sell those assets, you need to consider the depreciation recapture on that asset at the rate of 25%, right? So depreciation is a great benefit, but you do pay it back when you sell the asset or vehicle or property, right? So for non-residentials, I have few real estate clients that do syndication, fix and flip, and I have short-term rentals and long-term rentals, right? When they talk about cost segregation, and I tell them, like, cost segregation is not applicable for every real estate activity that you do, because your activity is considered passive if you are not materially participating in the real estate activities. So you really need to make a very, very important, you have to have a very important conversation with your tax professional if you are a passive investor or a dealer or a non-passive, because that's how IRS categorize, because IRS categorize your active income, your passive, and your portfolio income, and they all have different tax implications, right? So for cost segregation on my real estate clients that actively manage those assets, right? That's accelerated depreciation. Yes, that's drastically reduced the tax liability, and they might not even owe any tax, right? For this year. But I always tell them that when you sell, you're gonna pay 25% depreciation recapture on the asset. Section 179 expensing. Now we can choose between, as a professional, I can make a assessment if I'm going with bonus or 179. The only difference between the two is the thresholds, right? Bonus is 100%, does not carry over, but section 179 does carry over. And there is a threshold of, it was 1 million, up to 1 million, you can have a maximum deduction. But now for this year onwards, that increased to 2.5 million. And the maximum threshold under section 179B2 changed from 2.5 to 4 million. And if you're buying assets exceeding 6.5 million, that completely phase out. The next one is qualified small business stock. Now, this is really important for those that are either investors looking to invest in other companies, or have IT companies and they're trying to qualify for Section 1202, qualified small business stock. Because what this does is, this is going to let you have a tax-free exit from your business, right? So when you sell your share, you're not going to pay a capital gain tax up to $15 million, right? And as an investor, if I want to invest in your company, I will ask like, hey, are you a QSBS? If yes, then what I'll do is I'll buy the stock, I'll buy the share, hold my shares for 3 years, and can have 50% of the gain excluded. If I hold it for 4 years, I can have 75% of the gain excluded. And if I hold it for 5 years or more, I can have up to 100% of the gain excluded. But this is only applicable for stocks acquired after the date of enactment, which is July 4, 2025. Now, here is domestic R&D. Again, this is for those that does a lot of software development, and they hire foreign contractors to do the research and development. But Donald Trump wants the domestic R&D to be fully deductible, and that's why this act is really helpful for those that amortize the R&D cost in the prior years. They can choose to amend the returns and claim the deduction. It's an amazing, I'm helping 3 clients just to claim this deduction so that they can get a refund because they didn't amortize it. Foreign R&D will still be amortized over 15 years, but our domestic R&D research and development cost will be fully deductible. But for prior years, it used to amortize in 5 years. Now, this is the de minimis rule for third-party network transaction. PayPal, Stripe, any third-party network that you're using in your company, they are required to issue you a 1099-K if both conditions are met. Total payments to a payee exceed $20,000 and number of transactions surpasses 200 within a calendar year. So keep that in mind. And then there is an amendment that there will be a backup withholding for reinstated 1099-K. Backup withholding only applies when exceeding the 200 transactions and 20,000 payment threshold. There will be a backup withholding. Now, there is another rule that talks about the 1099 NEC, non-employee compensation or miscellaneous payments. So if you hire a contractor, first thing, you need to get their W-9, right? You need to make sure that they're authorized to work in US. So get their I-9, W-9. And if you are making payments to them, which is over $2,000, right? But is 600. So if you make a payment to a contractor over $600, you're required to issue a 1099 from your business. The only time you'll not issue a 1099 to a company, when a company is a corporation or a S corporation, you are not supposed to issue a 1099. But for contractors, for small businesses, 1099 is a requirement. It's mandatory for all business business organizations, and if you're not doing your due diligence well, you can be audited, and you'll end up paying, you know, a lot of penalties and on that. So please make sure that you have a written business plan and you know your due diligence processes for your company. If you're in the product industry, make sure you have your sale and use tax compliance done. Make sure you're taking care of the economic nexus in other states if you're selling products in other states. And if you're in a service industry, make sure you have a good P&L that talks about the chart of accounts, multiple streams of the, you know, of the income. It applies to product industry as well. So your permits, your insurance, your compliances are really, really important, because every state has, you know, different compliances, right? We are in Texas, which is a no income tax state, but Texas does have some compliances for the companies. If you have a LLC, make sure you can look up on Texas taxable entity and check if your LLC is active or dissolved, right? Or is it inactive? Did you file all your Texas franchisee reporting? Did you file all your sales tax, right? All that really become a very key factor when you're doing a business, because in the eye of state and IRS, your business is to make the business intent is to make profit. And it's not a hobby, right? Because IRS has rules. There is a hobby loss rule. If you keep showing losses for 3 years out of 5 years, they'll disqualify, and you might end up paying that tax back, which you took it as a loss, and reduce your taxable income. So make sure you have a very good due diligence process for your businesses. Another one is the extension and enhancement of deduction of QBI. Now, qualified business income, right? So qualified business income is for those where, you know, it's basically SSTB. If you're a specialized service, like I'm a SSTB, I qualify for SSTB, right? I have a phase out on the QBI. But for those, you know, who are under Schedule C or S Corporation, now S Corporation has its own compliance, right? Corporation does have its own compliance. So as corporation, you have to pay a minimum wage to yourself, right? It's a reasonable compensation that you need to pay. IRS only disqualify as corporation rule for reasonable compensation if the business is in loss and you don't have money to pay yourself. But you cannot take draw from the business, because if you're taking draw from the business, IRS will recategorize that draw as a wage and you'll end up paying payroll tax with penalty and interest, right? So the QBI deduction is at flat 20%. And if you're a S corporation, make sure you're looking at your wage and the qualified property requirement on your basis worksheet, which is very important. S corporation has three important rules that you need to look into. Reasonable compensation, you must have an accountable plan. If you pay out of your pocket for business expenses, the business has to reimburse the owner on the basis of what is stated on your accountable plan. And the third thing is the basis worksheet. You cannot take more money out of your business if you don't have a basis. Now, what is basis? Basis is increased by your contribution and your income to the business, and it's decreased by the losses, right? And the draws, right? So you have to make sure that you are talking to your professional about what is my basis in my company, and what can I do better to reduce my taxes. And then your professional should be able to guide you accordingly. Maybe you have S-Corp and you're not the right fit for S-Corp, because S-Corp is not the perfect tax election. It has its pros and cons as well. So QBI is where IRS is saying that even if you have $1,000 as business income, you still get a $400 minimum QBI deduction. 20% on 1,000 is $200. But this rule will let you take 400. So keep that in mind. And this will be effective in tax year 2026. Currently, we're getting 20%, but the minimum 400 will be added in the 2026 tax year. Business meal deduction, it's for those who are in commercial fishing operations, doesn't apply to us. But the business meal and entertainment are fully deductible if you have a team's event where the benefit is not for you, but for your team. Then you can deduct it, because let's say you're doing a team conference, right? But it has to have a very strong work papers, right? You need to prove that, yes, it was necessary and ordinary, it qualifies for ordinary expense. It's a team event. We're providing meals. It's a business development conference. And for your employees, yes, you can fully deduct that. Additional interesting provisions, there is a charitable contribution from the business as well. For individual, the floor was 0.5% of the adjusted gross income for the individuals. For the business, it's 1% floor. And all the credits are sunsetting. So if you're still planning to get more of solar or electric credits, that's going to sunset very soon. There is a change on business interest limitation as well. Earlier deduction was based on EBITDA, which is earning before income and tax, and now it has changed to EBIT only. Additional interesting provisions are for those that have this is for employers that have payroll, and they run payroll for the employees. There is a paid family and medical leave credit expansion. Employers are allowed to claim a credit equal to the specified percentage of wages paid to the qualifying employees during period of family and medical leave. And this is really good. They can calculate, employers not allowed to deduct amounts used to calculate the credit for insurance premium, but they can take a credit based on the two distinction method. They can choose a method, whether they can claim the credit equal to the wage or equal to the percentage of premium paid for qualifying insurance policies, regardless of whether the employee take leave or not. And then there is an employer-provided child care credit as well. As an employer, the credit, I would like to take the credit if I'm providing, the child care facilities to my employees. The credit limit increase from 25% to 40% for qualified expenses, with eligible small business receiving an elevated credit of 50%. And that's about it. And I also wanted to talk about the planning, right? What the planning does, right? And I just mentioned that this presentation is to build awareness of the effect and changes. It's really for informational purposes, but the bill is these slides are prepared by me, and I took the material from the AICPA and the Texas board, and I prepared the slides for my audience. And now before I take the Q&A, I want to give you a tax planning example. Okay, this is really helpful. And I think I covered it in the last slide as well. So this is a test client, right? He came to me with $250K of the W-2 wage, and he had taxable interest and dividends on his tax return. And he was providing a consulting services with $350K of the 1099 NEC that he received. His taxable income was $650. For current planning that I did, if he didn't go with the plan option, if he didn't choose me as the certified planner, or he just ended up, getting this taxable income of $618K, he would end up paying $182K to IRS for this year on the taxable income of $618, right? So I did scenarios for him after understanding the goals. That is he looking to add investor? Is he looking to add more preferred or common stocks? And what is the business intent? Does he have more medical expenses? Does he have more debts? So I asked all those questions and prepared, the comparison between what he's getting now and what can he save if we do S corporation or C corporation for him. So if I elected S corp, when I elected S corp for him, I brought his income down to 456 only, where he saved close to $81,000 in S corporation. And if he chose C corporation, he could have saved $84,000 in the C corporation. With S corporation, there is number one, S corporation rule is to run a reasonable salary. As a consultant, if he had to do the job, and if he had to hire somebody who could do the same job as him, he would pay close to 100K in salary, right, in wages. So if you look at line number 2, I put 100K as S-Corp reasonable salary to himself. So he paid a W-2 to himself from the business. And then the K1 that he got from the S corporation brought him down to 110. But that does include credits, deductions, and tax advantage strategies. I elected, he wanted to have a retirement account, and he also wanted to have a Roth IRA where his account grows tax-free, right? So all that became a part of the planning, right? When I elected the, when I created the retirement account, when I did the retirement account calculation for him, I chose the in-service conversion to the Roth IRA where he optimized his Roth and he optimizes 401k too, as well. And he was working from home, so his home office deduction, his mileage deductions, and other benefits were taken from the accountable plan, and that brought his income down to only 110 from the business. And I would choose a C corporation for those who are not looking to add more investors or whose interest is to just optimize the current expenses, right? I have one client who I elected C corporation, but C corporation, keep that in mind, it does pay double tax because the dividend apportionment is not done right. But C corporation is a great entity type if you know how you can have your C corporation invest in other businesses, because C corporation is taxed at 21%. So if you have high medical expenses, you can have a MORP account from your C corporation to lower your taxable income, right? And you can have your C corporation invest in other businesses. And instead of taking draws, tax-free draws from your C corporation, you can increase the salary component and add non-taxable reimbursements from the C corp. So there are a lot of ways that it can be segregated, because C corporation pays its taxes independently from your individual, right? So it's a great entity for those who are making at least $500,000 from the business. Now, this is the purchasing power and the debt service I did for one of my client where he had 1 million in real estate, he had 500K in debt of equipment and machinery, so he owed 1.5 million, and he was at S Corporation, when he came to me. And I told him that to cover $1 of debt service, the S Corporation needs to generate $1.69 because of the calculation. Pre-tax income, and C corporation generate less as compared to S corporation. So you would want to work harder to pay that debt, or you want to work less to pay the same debt, right? So, and I told this client that S corporation is a pass-through entity. It goes on your 1040. The maximum tax rate the S corp pays 37% plus the 3.8, which is the NIIT tax, equals to 40%. C corporation pays its tax independently at 21%. So if you all fall under 21%, you don't have to worry about C corporation. You can operate your LLCs as Schedule C on your 1040 as well. But the compliance, the work paper, they're really, really important. So make sure you have a good keeping for your invoices. Your accounting needs to be perfect, because if your numbers are overstated, you end up paying more in tax. So make sure your accounting, your chart of accounts, your balance sheet, your P&L, really your financials make sense, because tomorrow when you go to a banker to get a loan, the banker looks at the financials and the tax returns. So if your financials and tax return do not match or have discrepancies, that's a red flag. So make sure you have a good system, a good accounting system, and you're talking to your professional on just not the tax strategies, but also on how you can improve your accounting processes, right? And this is about me. My office is based out of Great Point, Texas, which is near DFW Airport. And I provide fractional CFO services, which includes budget forecasting for my high income earners. I do provide accounting services for small and medium business owners. If you know somebody who has a notice from IRS or lien on the property, I do provide IRS resolution services as well. Or if you have not paid taxes for the last years, I can help you get the evaluation done on your taxes. And I do provide audit support and tax planning for medium and small business owners. So I'm not just a CPA, I'm an IRS enrolled agent and a certified tax planner. So on that note, I end my webinar, and I'm happy to take questions. So let me do
Okay,
this.
so I don't see any questions in the chat yet. If any, I'll give that a little bit.
Yes, please ask questions, because this is a great, This is a wonderful time to ask questions. It's really informative. You can ask any tax questions that you have. You can also, scan my QR code, book a 30-minute free consultation with my firm, and I'll be happy to, discuss your tax situation and answer any of your questions if you're not, asking here. So I'm fine to talk to you offline as well.
So we have plenty of time left in this session, and I really want you guys to take advantage of having her here and being able to ask those questions. So
I
anything that y'all have, we'll give it a few more minutes, see if we can get some here in the chat.
Katie, I hope the webinar was not overwhelming. I know I talked about a lot of things, and it was a lot of, a lot of slides and numbers, and I hope I did not overwhelm my audience.
It was great. No, it's really good information. It's stuff that we all need to hear. No questions. Thank you, Miriam. Victor, the Maria, schedule consultation. Awesome. Can you elaborate more on the tax deduction for C-Corp for business meals?
Yes, so business meals are usually 50% deductible, but if you qualify for, if you provide events, in your office for your employees, and you're including the entertainment and the business meal, it's a part of the business development, under business development section or event, you can take 100% deduction as an event, for the event, like a professional event. So you can include that there, and I can send you the. I'll have the list of attendees, and I can send you the reg also on the business meal when it's deducted and when it's not deducted. Thank you, Megan. It was really
You,
good
yes.
question.
Terrace, I'll have to watch the session again. Too much valuable
And
information.
I also want to add that why professionals take 50% of business meal, because it's so hard for clients to come up with the work papers, right? They don't keep a backup of all the events that they did. They don't have the receipts. They don't have the agenda for that event. So it's really hard. If you have the agenda, if you have the event, just like, how I was there at the BBB office, right? Now, if the office wants to take the write-off of the food provided by the office, right, for BBB organization, they can easily take 100% deduction, because that event is, well, that event was hosted, to recognize, in companies, in Texas. So it was 100% write-off.
Great information. Yeah, Charles, it's it's recorded, so it's going to be emailed to you probably, hopefully by tomorrow. If not by tomorrow, hopefully by Monday. See how quick our team can get it out to you, but shouldn't be more than a couple of days.
Yeah, and please, please take down my information. I won't mind answering any of your questions, be it tax question, be it retirement question, be it, financial accounting question. I'm happy to, direct you even to attorneys that I work with for will and trust, because that's really important, topic of discussion. But I don't practice law, so I don't talk more about will and trust, but I do. When I see the tax return, and when I evaluate the net asset, I tell my clients that, hey, you need this, because I'm doing my due diligence. I'm doing my part. I don't tell them that I'm going to create those documents. I refer them to the attorneys that I work with, and they create the will and trust document. I tell my clients, even if you have one property, get the will and trust. You don't want to go through probate process. I'm helping a family where the family, they met with an accident, and I'm helping the son who's going through the probate process, because the father had the will, but they never updated the will. So if you're not updating your will and trust documents, you're just wasting your money. So it's really important to update your trust and will documents every 6 months. I would say, if your income and assets are changing frequently, you should update it as your income and assets are changing.
Okay, I'm gonna just give this maybe about another minute and see if
Yeah.
we get anything else come through.
And I can talk about the tips that I always give to my business clients on how to manage mileage. There is an app called Mile IQ, which you can download on your phone, and it's so easy to track your business miles because that become your work paper, and IRS does accept that. So make sure you're not making any changes to the log, and it's clear. It talks about it. It describes the miles driven and what was the purpose of the trip, right? So that's really important. And for invoice management, I know my business clients always ask like, oh, do I have to keep paper copies or digital copies? I tell them, keep a digital copy, get all the invoices in a drive. So if you ever get audited, you know where your files are saved, and then you can pick up the invoices that IRS has question about. IRS will look up, for amounts that are high in dollar values, right? So if you're buying a $10,000 asset, yes, they will look at it. They want to see the invoice. But invoices like $50, $10, they don't really care. So I tell my clients that less than 75 is okay. You don't have to keep a receipt, but you should have a purpose. Like, what is the business purpose of making that purchase, right? That's really important. And so I use Ramp. I have heard good things about Expensify as well. You take a picture and sync it to your QuickBooks. It's a really easy invoice management system. And yeah, I mean, it saves a lot of time, and AI is everywhere. So AI does help in expediting most of the manual task.
Yeah, we use Expensify for our expenses. It's so easy to use. So
Yeah. I have clients, I use Expensify too. I have clients using Ramp, R-A-M-P, Ramp, Expensify. There's so many platforms, out there.
well, it doesn't look like we have any other questions or comments. So I'm going to go ahead and wrap it up. You guys have her information there on the screen. Of course, you can always reach out to us if you have any other questions. But I do want to thank y'all for jumping on here today and taking time out of your day to really arm yourself with education for your business. Again, keep in mind that we are doing these every single month. Next month, next month in October, we're going to have somebody present on AI, which is we had her do it earlier in the year. Really great presentation. So that should be up on our website probably next week. But thank you guys, and thank you, Shalini, again for doing this for us. And I'm so glad that you mentioned you were a Spark Award winner. I forgot to mention that. So that is one of the highest honors that BBB gives out to businesses. So congratulations on your win for Spark. So everybody else, again, this will be emailed to you probably in the next couple of days. If you guys have any questions, reach out to us, and I hope that y'all have a great rest of the day and a great rest of the week. Bye, everybody.